Good afternoon, everyone. This is Henry Gambell with SimplerTrading.com, and in tonight's free video, I wanted to share a couple of earnings ideas with you, and some they kind of strike me as hot tech names that may be open to interpretation a little bit, but you've got Activision that after EA came out with a nice report on their end. Sometimes these can be considered as companion stocks. So you say, okay, EA had a good report. If we come back and look at Activision, who is due to report about the middle of the week heading into, right now it's the 1st of November. So we've got the earnings due out on the 7th here. So it'll be about the middle of next week. But the idea is looking to this and thinking that there might be a little bit of anticipation ahead of this report, or maybe even a little bit of optimism. And ahead of that, you should see an expansion in the volatility of these options. So what you come in and basically look to do is buy a call option and buy a put. Now, if you look at that and say, well, which way are you looking for it to go directionally? You don't really care because your deltas are relatively small. If it does have a big directional move, that can make you money, but what you're trying to capitalize on is that the implied volatility will expand prior to these reports. So, something like this you're not usually looking for a home run type trade on, but can you make, 20, 30% on it? I think that's a totally viable target, and I think that's a trade that you could still try to pick up on Monday and see if you can get a little bit more juice out of it right up until they report the numbers. You do not hold this strategy through the earnings. You take it right up until the point where there's kind of ideally, hopefully, the most amount of anxiety just before those numbers are released. You sell into that, flatten out, and then you're not really as concerned about what actually happens with the report itself. One other place that I think could be an interesting name for that is here in Roku. So it's exactly the same idea where you're just buying the options on both sides, and then if it does have a big move one way or the other, that's still good. The only downside of these trades is they are theta negative, so the passage of time is going to work against you, but ideally you make up for it with the rise in implied volatility or a big move. At the very least, these contracts are not going to go to zero before the earnings come out, so the odds of taking a big loss get cut down a little bit, and that's part of why I like those. So I hope that's helpful and gives you a couple of things to consider as we get into some of these next earnings that are due up next week. Y'all have a good weekend, and we'll see you at the next free video.